So LTL carriers in the industry, if we're talking in relation to damage claims, almost all of them will self-report that their damage claim ratio is less than 1%. Some of them, when you call their customer service line, actually have that metric playing on repeat, that less than 1% of shipments are claimed. And they choose their wording carefully because what they're talking about is shipments that they end up actually paying out on a claim. And it's a deceiving number because of all the variables that go into, I would say, LTL damage claims. One is concealed damage, the fact that if it's not reported within the first 3 days and there wasn't a notation on the POD, then even if the shipment was clearly damaged, you can have pictures of it and everything, it's not a claimable shipment. So that doesn't count against their stats. And there's a lot of mishandling of claims based on consignees not signing the POD, but also not reporting it within 3 days or 5 days if they didn't sign it on the POD. So if it's mishandled up front, it doesn't count against their stats. And then if it is, improper documentation, or maybe the packaging that they used by the NMFC class or NMFC code didn't meet the requirements, which are very stringent sometimes and, convoluted, and nobody just has that memorized, certain items can't be, claimed. And so all of these LTL carriers, they have their own different liability, and we're putting out the newsletter to kind of break that down and carrier liability versus insurance. But if you look at it as a whole, self-reported freight claims versus actual shipments with damages by carrier, there isn't a real good system out there to actually track that. And so I think that's an industry problem. I also think that a lot of carriers will put damage claims into, instead of like a P&L of like, hey, this is how much we paid out in claims. They almost treat it like billing variances. They're like, hey, how much can we recoup by not paying claims? And then our OR is a lot more friendly for our investors, or rather for public markets. So that's my take on it.
One of the things that we focus on at Rocket is educating our customers on damage claims. Whether it's a concealed damage claim or there's a clear damage claim where the POD is signed by the carrier. The differentiator is if it's signed by the carrier, then we can dispute those right away and provide the proper documents from our customers. And if it's not signed and it is concealed, then the customer has 72 hours to report those photos and proof of the damage claim to initiate the claim. With concealed damage claims, a carrier will only pay 1/3 of the actual value of that freight. So it's very important to educate our customers to sign the POD and make sure they mark it as damaged.
Michael, let's talk about insurance.
Because damage in this industry is such a big thing, and it really stinks to try and mitigate claims via carrier liability, which can be all over the board. There's no standard on liability. A lot of customers will resort to the idea of using a third-party insurance provider. You set it up before before the shipment goes out. You pay the premium, and then if there is some sort of a damage claim, that insurance provider will go out and mitigate while paying you the value that you insured for within the first 30 days.
Yeah, and then like, how does that work? Do they have like, does the insurance provider just charge a premium, or is there a deductible? Like, how does that work?
Yeah. So with third-party insurance, there is a deductible involved and a premium. So the premium will be based on the value that you associate with that shipment, and their deductible is also in tiers. So premiums in tiers, deductibles in tiers. A lot of times, the deductible can be anywhere from $500 to $1,000 deductible if there's a claim initiated.
You're talking about third-party providers for insurance and freight claims. Most of the issue is that insurance is all about risk management, risk analysis. What the premium is how much risk the provider, kind of assigns to that premium, or I guess what the premium amount is based on the amount of risk the provider assigns to that shipment and to that brokerage. And the problem in the third party brokerage industry and the big 3PLs is that they have blanket insurance programs that are for all of their customers. And so if there's any bad actors that take advantage and have a high claims ratio, and the insurance provider has to pay out a lot based on their actual documentation, they had to pay out a bunch of times, but then they didn't collect enough on premiums and they were upside down on that policy. I mean, honestly, insurance companies are never upside down, but not as profitable as they'd like to be. Then they raise the premiums and they raise the deductibles for the entire company. And a lot of these $1 billion 3PLs have insurance programs through, I won't name names, through several of the big insurance providers for cargo claims. And, when I first got in the industry, it was $20. One of the big providers, who's now three companies instead of one, they had a $20 premium and a $0 deductible for their insurance program. It was crazy, and you couldn't compete with it. Now, I think that same provider, and I don't have actual stats on this, this is hearsay, is 20 or 30 or $40 premium depending, but also the deductibles up to $2,500 depending on the product and the value. And so I think that people used to use insurance a lot more than they do because the premium was affordable and the deductible was negligible. But if you're shipping $1,000 item and the deductible is $500, you're better off just using carrier liability. And so I think that's part of the reason that third-party insurance providers for brokerages don't really provide as much value as they used to. And there's probably new players in the market I don't know about, but if you do, then just drop it in the comments and tell me who they are.
The idea that tracking the performance to go along with insurance makes a lot of sense, because even though you have a shipment that gets damaged and you have insurance and they will pay out in 30 days, a lot of the times, and it was more prevalent during the COVID era, was they couldn't even not, I wouldn't even say afford, but they would lose the customer, lose a sale if they had a damage claim, because they didn't even have the inventory to send out a second one. And so,
Yeah.
looking at the idea, of tracking performance by carrier, I don't want to take a crappy carrier and throw insurance on it and call it like a win. I'd rather pick a good carrier and then determine if I should add that little extra insurance on top of it for those
Yeah, and
reasons.
also this is a good discussion because I think that the more important factor is being able to do it at a shipment level in the
Right.
TMS. Most of the TMSs these days, none of them are like groundbreaking. They're all very similar, and it's like Expedia or Priceline. Everything is rate shopping the carriers by cost. Not many or any are doing it by performance and assigning a score. Now, even if you go a step further, you could say, yeah, this is this carrier's performance over the lagging 3 months. And some of the big 3PLs do that so that at least if you're going to book with them. ABF Dynamic might have very low liability, but it's a good rate, whereas XPO might have $5 a pound for liability, but it's the same shipment. And so it's not only different rates and different transit times, it's different liability coverages. And so that's why insurance has made it easier. But again, people play roulette all the time in LTL insurance. They say, I'm going to insure this one, and it goes perfect and nothing happens. And they're like, I haven't had a damage for a while. I think I'll stop paying $40 for my premiums. And then they lose a $2,500 shipment, and it's not marked by the consignee. Because when you're talking about damage claims and shortages for residential shipments, it's even more important because if it's going B2B and it's damaged, the business is like, hey, we marked it on the POD and we reported to our, wholesaler, hey, we need another product, ships out the next day. Everybody files and it's pretty clean, even though it sucks. In residential shipments, if it goes to a consumer, one, they don't know how to sign a POD and they don't know the process other than like the driver's there and gives them a handheld and says, "Here, sign. I got to go to my next stop." So that's one problem, education. And then the second part is if it is damaged, one, the e-commerce brand might not have it in stock. And if they don't, then even if you used insurance, you get your money back, but you lose the sale. And two, you have to ship it out immediately. Like you can't wait for the product to return, inspect it, and then say, hey, we could fix this and repair. It's more, I got to ship a brand new sofa out right now. And you have to then wait 180 days to get paid for that claim, but you paid freight twice. You had to return. There's 3 freight charges total, and you are out money on the claim and you're holding the bag. So for residential home delivery, I think insurance or a shipper's protection or shipper's interest policy makes a lot more sense because you're floating money already by drop shipping, or if you're the manufacturer, you might maybe have it in stock. But this is more specific to the drop shippers of the world where they might not have the inventory available to them to get them a new product.
It comes down to education. Can we educate the customer on, like, hey, make sure you walk around the shipment and inspect it before you sign the POD? And there's plenty of ways to try to do that. Obviously, it's never, it's maybe 50-50. I look at it as it's a frustrating and a little bit maybe overwhelming situation when you have a carrier pulling in potentially with a 53-foot trailer or a Sprinter or pup truck, and they're literally, bringing down a pallet of something. It's kind of an overwhelming experience. You might forget, and if it's damaged, you're so frustrated, all you're thinking about is getting that driver out of there and then calling the company saying, you guys screwed up, why'd you pick this? But
Yeah, I think often they just try. They're like worried about calling the company, and they're not even
company's
worried about
fine.
interacting with the driver. They're like,
No,
well,
get
and it's
out of here.
logical. They're basically saying, hey, I know that the driver didn't damage this. I got to contact the people I bought it from right away. But in LTL, and this needs to change in residential delivery, just because it was concealed damage, if it was to a residence, that should just be a damage claim so long as there's pictures and it's within 72 hours. That's
Yeah.
my hot take. That should just be a standard damage claim. If there's pictures to prove and you can tell it's a forklift hole, everybody knows it's from a forklift. There's two evenly spaced holes in this box. I think that it's pretty obvious that carriers don't want to deal with that liability. So they just say, hey, that's a clean POD. A lot of these are like just handhelds. During COVID, it came out with the handhelds. Like, it's not even a piece of paper. So they're just saying, here, scribble your finger on this, and then I'm going to leave. And the drivers are, their job is to get it delivered. I think there could probably be better procedures at the actual destination terminal to inspect it before you even bring it out there. If it's damaged, why bring it to them? There's a lot to improve there. Now, some of the home delivery carriers do a good job at this and pay normal damage claim instead of concealed. They take pictures and upload them same day. Those are the good ones to use. So,
Yeah. The other thought I was thinking about going down is let's say that, we can never get the customer to abide by this SOP that will save everyone time, headache, money. Um, the idea of, if we still want to use standard LTL carriers, the idea of using a standard LTL carrier as a first mile and just running a B2B move. We already know that B2B, when you're in that business, you know what the process is and whatnot. And finding a final mile carrier just to run that threshold delivery, the experience is going to be better. We don't have to rely on the customer of our customer, so the end consignee, to do anything right, because
mhm.
the final mile carrier will do that, and then we don't have to worry about there being any concealed damage or overall damage or any of that stuff because it's checked upon when it's delivered to the dock of that final mile carrier. So we might find that if we start doing some data collection and say, hey, with this SKU, or maybe it's just an entire collection, but whatever it is, when we have a damage claim, we always lose this much money, and we can look at it on the POL and say, you know what, over everything, over our entire supply chain, this SKU, we lose, we lose $50 a shipment, no matter what, across it all. We could just instantly say, well, instead of even trying to guess and throwing insurance and all this stuff, why don't we move it to a first and final, and it'll cost more, but it'll cost less than that $50, and the problem goes away for good.
Yeah, and that's literally the principle of freight cost savings versus hard cost savings.
Right.
And actual, we have one customer who ships an 8-foot dining table, and it's an amazing dining table, but they can't palletize it because it doesn't really make sense to put on a pallet for them, and it's their number one SKU for damage. And the amount of times that they don't have it in stock after a damage, like, it's so frustrating for them and for us and for the carrier. And then, this is another misnomer is, and this is probably a hot take for, like, if the shippers out there that are listening probably disagree with me on this, but a lot of times somebody will ship a LTL order with one of the big five carriers, we'll say, and it'll get damaged. And then they say, yeah, we have to reship it. And they insist on using a different carrier. They're like, we
Yeah.
cannot use that same carrier because they already damaged this. But it, like, mathematically, if that's the highest performing carrier and we've got stats on that, and they're a high performing carrier, it doesn't actually make sense, other than optics to the end consumer, to ship it with a different carrier. And so we see that all the time. And it's like, you have to ship it on a different one. That's our SOP. I get it for the optics to the consumer, but the actual chances it gets damaged twice or maybe even higher because you might have moved it from your top performing carrier to the next one. The only way I think that makes sense is if it's a VIP customer. Like I would, anytime it's damaged, I'm like, let's ship it back on Old Dominion. Shout out to OD. I guess they're going to get a little free press here, but I would ship it on like a premium carrier if I was in the middle tier, and it's going to be another $100, but they're not going to damage it. And so whether it's optics or not, I see people use the middle tier carriers and they'll just switch it to a different middle tier carrier. And I'm like, that doesn't add up. If you're going to use a different carrier, at least use OD. Don't use one of their competitors. So
That recently happened with a client. It wasn't a damage, but it was a problem with pickups, and they were using the cheapest carrier. And then instead of moving it to a, better performing carrier, they just went with the second cheapest option, which that carrier's performance isn't really that great. So
yeah,
trying to educate your customers on, yeah, you're going to spend more, but you're already wasting money because now that shipment is late. So you might as well just spend a little bit more and get that service.
yeah,
One more angle, and there's a million angles to look at this, but thinking specifically like um, either drop shipping customers or just customers in general. A lot of times we'll see customers that have warehouses on the east or west coast. They're close to the ports, right? It makes sense. Like, let's get it to the warehouse as cheap and as fast as possible and then go. But
yeah,
the moment, and you said it yourself, if the customer has a warehouse in Seattle and shipping to Florida, I mean, yeah, there's differences in performance substantially by carrier, but at the end of the day, doesn't matter the carrier. Every terminal that a shipment has to go through to get to that final destination, and let's say from Seattle to Florida, it's like 3 or 4 terminals for any carrier. There's always intrinsically a higher cost. It's going to get damaged because it's got to be loaded
yeah. It's the
off of a
amount of
truck.
touches.
So at the end of the day, you could look at it one step further and say, well, yeah, I could go OD from some Seattle to Florida, and it will be a better performing, better chance of it getting there without damage. Or we could look at the idea like maybe we just look at how can we find another warehouse that's a little bit more centralized in the States or closer to the East Coast where we could bring a truckload of your products, very low percentage of chances that it's going to get damaged from the port to that warehouse. And now all of a sudden, we're only moving one terminal, or maybe it's not even a terminal. Maybe it's a direct move. So there's another angle to look at it. There's a million ways you can look at it.
Yeah, I think that furniture companies almost always ship near the port for their warehousing. I would say I don't know any furniture companies that are shipping. Well, I do actually know a couple of patio furniture companies that ship out of the middle of the US, but most, I'd say 98% of all companies that are shipping stuff in containers are shipping close to LA Long Beach, close to Seattle, close to Vancouver, close to, uh, in Texas down there, Houston,
Mm-hmm.
close to that area because they're bringing it, and then their drayage is cheaper. But if you maybe looked at the analysis of distributed warehousing and having 5 warehouses across the US so that you're never going more than 2 terminals for furniture on luxury or high end furniture, I bet it would wash completely the cost of the truckload to get it there for the drayage comparison. Never even thought about that.
Plus the transit time, considering we're
Well,
not
yeah,
looking
if
at
you have
transit time goes
consumers that
down.
care about how fast you get it there too.